June 1st was the official start date of quantitative tightening, or QT for short. Today, we'll talk about what QT means, why it's starting now, and the decision makers involved. First, on the decision makers, we have talked in prior videos about the job of the US Central Bank, also known as the Federal Reserve or the Fed. They have a dual mandate of obtaining maximum employment and managing the level of inflation in the US economy. At this time, the unemployment level is relatively low at 3.6% unemployed. Good news. However, inflation is at multi-decade highs with headline inflation just over 8%. This elevated level of inflation has had a large impact on spending and spending patterns. In order to talk about quantitative tightening, we are first going to address its counterpart, quantitative easing, or QE for short. QE is a strategy used by central banks to stimulate economic growth. Central banks effectively increase the money supply in the economy by purchasing long-term bonds, most commonly treasury bonds and mortgage-backed securities. Now, this strategy helps lower interest rates or borrowing costs, which then makes it easier for banks to lend and for people to borrow. QE started in a larger fashion in 2008 and 9 during the Great Financial Crisis. More recently, when COVID hit, QE was ramped up substantially. During this time, quantitative easing added about $5 trillion to the prior $4 trillion the Fed pumped into the economy. Again, this was the Fed buying long-term bonds to help support and stimulate the economy. As a result, the Federal Reserve balance sheet now stands just shy of $9 trillion of assets. Now, with inflation levels high, in comes quantitative tightening, which is the act of reducing the balance sheet or taking money out of the economy by either letting bonds held by the Fed mature without replacing or outright selling of bonds by the Fed. This part is sort of like opening a stopper drain on a bathtub full of water and letting the water drain out over time. The goal of this strategy is to help reduce the level of inflation in the US. So while easing spurred inflation, tightening has the goal of reducing inflation. Of course, the Fed is attempting to do this without slowing economic activity too much and triggering an economic recession. See our recent episode titled Rear View Driver for more on recessions. Next, let's dive into the tightening playbook. The Federal Reserve has well telegraphed its intentions to avoid the risk of creating any surprises. After all, when it comes to financial markets and the economy, nobody likes surprises. Starting June 1st, the Fed will unwind $30 billion of treasury bonds and about $17.5 billion of mortgage-backed securities for a total of about $50 billion. This will occur over a 3-month period, and in September, these amounts are expected to increase. So let's do some quick math. If the Fed removes $50 billion from a $9 trillion base amount, that equates to about 0.5% of that total base amount. So it's really a pretty small amount. However, the key here is the direction of their actions, not the magnitude. So if the goal of QE is to ultimately spur growth in the economy, does that mean that QT or tightening will hinder growth? Well, this part is not so clear. It will depend on how quickly inflation decelerates and how aggressively the Fed chooses to take action in the future. According to the Fed, quantitative tightening does not have an opposite and equal effect as easing. In fact, former Fed Chair Janet Yellen once described quantitative tightening as something that will just run quietly in the background over a number of years, and that it'll be like watching paint dry. Whoever thought watching paint dry would make headlines? From a portfolio and investing perspective, there is uncertainty in the markets, though there's always uncertainty, especially in the short term. We advocate for remaining highly diversified with investments, sticking to the long-term plan we created together, and maintaining levers ready to pull for a variety of conditions and outcomes.